I guess most people are looking at the market's response to the Trump victory, which I suggest is mostly a whole bunch of to-do about nothing. I'm much longer oriented. And as always, I'm trying to figure out what's cheap and what's not cheap. And among those things that are cheap, those things that I understand. I look at the broad landscape as an example in the United States market. And despite the fact that I'm starting one, I think community banks are really cheap. People are pricing them as though other folks won't need banking services for the next 30 years, which is absolutely stupid. I think that there's a lot of indecision around the good, the bad, and the ugly among the uranium stocks, and people tend to value them the same, although there's vast differences between the companies. So I'm trying to take advantage of that. When I look at the investment landscape going forward, of course, all things change, but I'm struck by the similarities between the circumstances that confront us now and the circumstances that confronted an earlier generation in the decade of the 1970s. Incipient inflation and the lack of understanding about the way inflation impacts the purchasing power of one's savings, and the potential both to decimate the long bond market, decimate savings, and reward those investors who participate in alternatives. I see some little banks that have consistently generated 15% plus after tax returns on equity, and I see these banks selling at a discount to book. The idea that I can buy a well-run local franchise that's generating 15% after-tax return on equity, selling for 70 or 80% a book, is the same thing as as being able to buy 18, 19, 20% internal rate of return, and I'm attracted to that. Some bank investors look at the great big banks, the too big to fail banks, and they look at the fact that because they have the implicit federal guarantee, that their cost of capital is very low. People are willing or stupid enough to deposit money in the big banks for no interest. Some little banks, including my own, are beginning to make some inroads on that. It's surprise, surprise. People, when they take the risk of depositing money, would like to get paid. It is a truism that the little banks can't compete with the big banks. It's a less known truism that the big banks can't compete with the little banks either. Because the little banks have expertise in their region or have expertise in their industries that the big banks simply can't afford to have. But that's narrative. What really attracts me is businesses that have historically generated 15% plus after tax returns on equity. Franchise like that, management teams like that, selling at 70 or 80% a book. There will come a time when those banks will be bought at 2 or 2.5 times book, having increased book at 15% compounded for 6 or 7 years. That sounds like an awful lot of fun to me, and nobody cares. I've owned those two stocks for a very long time, and they're certainly cyclical stocks. If one owns them through the cycle, which I do, they perform extraordinarily well. In addition to that, people knock them because they're slow-growing industries, which in fact they are. But they are both companies that have been reasonably successful at vertical integration, which is unusual. And they are companies that generally have, within a band, decent returns on capital employed. And because they're slow growing, they're usually kind enough to return a fair bit of their income to shareholders by way of dividends, and those are in fact earned dividends. Investors in the space need to be very concerned about the outcome of a peaceful resolution in the dispute between Russia and the Ukraine. When the Russians come back into the phosphate market, they are the world's lowest cost producer. For a while, that's not going to be a problem because the Russians have deferred sustaining capital investments. It seems the Russians have had other uses for money. And if you defer sustaining capital investments, you impair your ability to produce in the out years. We saw the Russian potash industry take 5 years to recover from the reorganization of Russia in 1989, 1990, 1991, the last time that the Russian state needed money to the extent that it needs it today. So, assuming, first of all, that peace occurs in the Ukraine, which I hope happens, there will be a time when the Russians and their friends, the Belarusians, retool their domestic industry, which will give the West some breathing room. When they retool in the potash industry, you need to understand that Russia can be the lowest cost and highest volume producer on the planet. The price of all nitrogenous components goes up. Natural gas is too cheap right now. It's produced as a byproduct of oil. The consequence of various technologies coming together with a very low cost of capital has meant that U.S. oil production in particular, but Canadian oil production too, has surged, and byproduct gas production has surged. The BTU arbitrage between oil and gas is too high, and billions of dollars are being spent on monetizing that arbitrage. Over 5 years, that'll be successful, but it won't be successful in 2024, 2025, 2026. The bottom line of that is that natural gas prices will rise. The consequence of that is that nitrogenous fertilizer prices will rise, and that will impact all the way down to the farmer. He or she will have to pay more for nutrients, but the nutrient distributing companies will have to pay more for that input. Because I trade it in a 5-year term. I don't attempt to trade it short term. As you suggest, there's so many variables that trying to understand the short-term market is trying to know the unknowable, which is a waste of time. But I like big math, Jesse. I like really, really, really big math. So let me give you some oil and gas big math. The price of U.S. natural gas, Henry Hub, is about $2 per million BTU right now. Canadian gas is even cheaper, $1.50 Canadian, about $1 US ACO. That same gas per million BTU landed at Rotterdam or Tokyo or Shanghai goes for $8.5, $9 US. Takes a couple bucks US to get it there. That arbitrage is too great to continue. And there are billions of dollars being spent every month to address that arbitrage. Gas storage, gas gathering, gas processing, gas transmission, liquefied natural gas, deliquification plants, tankers. When you have an arbitrage that broad, against a different arbitrage, which is the BTU arbitrage between oil and natural gas, the energy differential is about 6 to 1 per barrel against a million BTU, 1,000 cubic feet of gas. Gas is selling at more than a 50% discount to BTU dollar parity. So you have these two arbitrages, one, the gas to oil arbitrage, and the other, North American to Europe or North America to the Asia. Market inefficiencies in markets that are measured in the tens of billions of dollars. Market inefficiencies of that magnitude, a 60 or 65% gross selling price inefficiency, get arbitraged out. Will I be right in 2025? Almost certainly not. Will I be right by 2030? Absolutely, positively, without a doubt. I've told you before, Jesse, that I love questions where the answer begins with when, not if. And that's what natural gas is. And mercifully for me, most of my competitors, including some of the biggest investors in the world, invest with a long-term narrative, but they use a short-term tactic. In other words, they invest in something with a 5 or 6 year outcome, and they have trauma holding stock over a long weekend.